Hey guys, welcome back to my channel. So a couple of days ago, I got this question from Charlie where he was asking, hey, I just opened a Roth IRA, can I buy VTSAX and VFIAX or is it the same? And I thought this was definitely worth addressing because these two are some of the biggest funds in the world for index funds. And first of all, Charlie, I'm really glad that you opened a Roth IRA and I hope that it serves you well into the future. For the rest of you guys, if you have any questions or on this video or any previous video, be sure to add in the comments because I do look at those and other people might have the exact same questions you do, and it helps me create more valuable content to serve you guys. So Vanguard VFIAX is one of the largest, if not the largest, index fund in the world, and it's a close cousin of VTSAX. So in this video, I'm going to do a very deep dive into VFIAX as well as do a side-by-side comparison with VTSAX, and so that you can make a more informed investment decision for yourself between these two funds. If we are meeting for the first time, my name is Sung, and on my channel I love talking about personal finance tips and investing strategies that have helped my family grow our wealth in our journey towards financial independence. If you too are wanting to grow your wealth so you can focus on what truly matters, be sure to subscribe so that you don't miss out on anything. Now, before we go any further, I need to state that I'm not a financial advisor and that this video is strictly for educational purposes only. I recommend you do your own research and, if necessary, speak to a professional in your area before you make any type of investment or financial decisions. This video is part of a series of videos that I'm doing on Vanguard funds, primarily focused around low-cost and broadly diversified index funds and ETFs that make investing as passive as possible while tracking the market performance. If you're new to investing and are not familiar with terms like Vanguard or index funds and ETFs or expense ratios or VTSAX, I highly recommend you take a look at my other videos, which I link down in the description below, and so that you can get caught up on some of these terminology and some of these concepts. But without further ado, let's go right into VFIAX. The formal name for VFIAX is the Vanguard 500 Index Fund ADMIRAL Shares. This fund tracks the most popular index or indicator of the US stock market, which is the S&P 500. The S&P stands for Standard & Poor's, and the 500 stands for holding the 500 largest publicly traded companies in the United States. And in case you're not aware, Standard & Poor's is a financial services company that publishes all sorts of financial research and analysis on all types of organizations, and they're the ones who maintain the S&P indices like the S&P 500 and which companies are a part of it. How these 500 companies are selected does have consequences for VFIAX, which we'll talk about in a moment. But for now, just know that there is a US index committee within the S&P organization that maintains the list of companies as well as reviews it every quarter. While there are written rules that guide when a company is added or dropped, the final decision is really up to this committee. There's numerous requirements that a company needs to meet, the most obvious one being its size based on market value, but also its ownership structure, the number of stocks that are traded by the public, and even the sector or the industry that it is in. All these things and some of the more objective criteria are taken into account by the committee in making their final decision. So if you are interested in learning more details about this, I added a link in the description below that will take you to the S&P US Indices methodology document if you want to dig into it further. As a footnote, VFIAX is not the only Vanguard fund that tracks the S&P 500. There's a mirror version of this fund called the VFINX, but it's basically closed to new investors. It had a lower minimum to invest threshold compared to the more exclusive ADMIRAL share class of funds, but it did come with a slightly higher expense ratio. The minimum to buy into VFIAX is currently $3,000, but if that requirement is holding you back from buying into it or any other fund, then try looking for the ETF version of those funds. For VFIAX, VOO is the ETF version, which you can currently buy one share at about $260. If you are currently employed and you have access to Vanguard funds through your company's retirement plan, then you might see funds like VIIIX or VINIX, which are basically the same thing as VFIAX or VFINX. These are institutional class of funds, hence the I, which are meant for companies or organizations, and they have a minimum to invest requirement of $5 to $100 million. One of the benefits of the institutional class of shares is that the expense ratios are actually lower compared to the consumer/retail versions of these funds. And so I recommend, if you have it available to invest in your company's plan, that you stick with that, assuming that all other costs are equal. For the rest of this video, I'm only going to be referring to VFIAX, but understand that pretty much everything I'm talking about applies to the other S&P 500 funds that I just mentioned. Okay, so going back to VFIAX and the S&P 500, here on the Vanguard Funds detail page, the fund itself actually holds the stocks of 509 companies. Now, if you go further down here, you can see which sectors make up the biggest share of the fund. And not surprisingly, the technology sector has the biggest share of all, and then followed by healthcare and financials. Going further below, here is the list of the top 10 largest holdings of this fund, and the companies should be pretty much household names, considering you probably do a lot of business with them, or you use these companies or purchase things from these companies. One thing to note is that because the fund is market capitalization weighted, these top 10 companies make up close to 23% of the fund's net assets. So these 10 companies have an outsized influence on how the fund performs. But when we look at the top 10 companies for VTSAX, which are actually the exact same companies because VFIAX is basically a subset of VTSAX, these same companies make up just under 19% of the fund's net assets. So this is the reason why VTSAX is slightly more volatile than VFIAX in the short term, because the largest companies tend to be more stable and experience less price fluctuations or movements compared to like the thousands of small and mid-sized companies that are in VTSAX. Here on the performance tab, I want to show you real quick the historical growth of the fund and how it compares to the S&P 500. Now, as you can tell, they're virtually identical. And as a preview, if I add VTSAX into the chart, they're basically the same unless you get down to the one-year performance in this chart, where you'll make out a slight divergence, which we'll talk about in a moment. Alright, so now let's go into how the differences between VFIAX and VTSAX should factor into your decisions. Now, right off the bat, in comparing these two, in the grand scheme of things, we're splitting hairs. And what I mean by that is you really can't go wrong with either one of these funds. The performances of both are nearly identical, the expense ratios are exactly the same, the minimum to invest is exactly the same. So for whatever reason, if you only have one option to you, then you're really not missing out on picking that option because they're both so identical. To split hairs just for kicks, let's start with the dividend or the SEC yield. Now, VFIAX has a yield of 1.93% as of July end, while VTSAX has a yield of 1.82%. So you may be wondering, why is there a difference here? Basically, larger companies are more likely to pay larger dividends or dividends at all compared to smaller companies, since they're more stable and they have the cash flow to pay out a portion of their earnings to their shareholders. On the other hand, small companies tend not to pay out dividends, but to reinvest their earnings into the business so they continue growing. So VFIAX, which is exclusively large companies, you would expect to have a higher yield compared to VTSAX, which has a portion of its holdings in small and mid-sized companies. So if you're looking for a larger dividend from your investments, then VFIAX is going to meet your preferences better, but VTSAX is really not that far behind. Moving on to the second difference, which is performance. Now, if you remember that one-year performance chart that we were just looking at, there was a slight gap between the two funds where we saw VFIAX was slightly better over the past year than VTSAX. While that difference is really attributed to larger companies having performed better recently compared to small and mid-sized companies. If you look at the same chart and switch to a 10-year growth chart, you will notice that one fund has a slight edge over the other during certain time periods. So as of August end, it looks like VFIAX would have given you a slightly better return over the 10-year period compared to VTSAX. So you may be thinking, what's the implication of this? Well, if you are of the mindset that larger companies are going to perform better in the next 1, 5, or 10 years, then it's probably likely that you would want to go with VFIAX to get that small performance boost. But vice versa, if you think that small companies are going to do better, then you would want to go with VTSAX so that you could capture that performance boost in a single fund. At the end of the day, no one can predict whether one group of companies will do better than the other, and it's not likely to make a big difference, so it shouldn't be a big factor in your decision, but it's just something for you to chew on as you're thinking this through. Moving on to the third difference, and this has to do with something called like index inclusion effect or the S&P 500 effect. And it's basically an issue that VFIAX, and other S&P 500 funds pay for as a consequence of the movement of companies into and out of the S&P 500 index. Now, how much they exactly pay for this is a bit unclear. Remember that detail about companies being added or removed by the S&P Index Committee? Well, as I said before, those changes happen on a quarterly basis, and the announcement is made prior to a company actually being added or removed. So if a company is being added to an index or removed from an index, by definition, all the index funds need to add or remove that company from their holdings at the same time. In theory and in practice, the massive buying and selling inflates or deflates the company's stock prices. And so you have these index funds that, like VFIX, that are buying at higher prices and selling at lower prices if it had not been for these companies changing the index. This phenomenon has been known for some time, and according to some of the research articles that I'm finding, the data seems to indicate that the effect has really peaked in the late 1990s and early 2000s. I have to think that fund managers are aware of this and that they have some kind of proprietary strategy to minimize the cost of this effect. For instance, like staggering their trades over a period of time. This effect doesn't really apply to VTSAX or other total stock market funds because these companies that are being added or removed in the S&P 500 index are already owned by them. If you enjoyed this video, be sure to drop a like and make sure you share with a friend if you think it will help them. Also, don't forget to subscribe to my channel so that you don't miss out on any new videos to help you grow your wealth. Thanks for watching, and I'll see you guys next time.